What is going on, everyone? Welcome back to the channel. I know I haven't posted a video here in a couple of months. Life just sort of got in the way, but I am back and I am planning on posting a lot more consistently to the channel because I really do like making these videos and sharing my ideas with you. So in this video, what I want to do is give you a quick update on Cumulus Media. This is a company that I'm super bullish on. It's one of my biggest positions, and they released their first quarter earnings report a couple weeks ago. And it just seems like every quarter this company is getting stronger and stronger. So what we're going to do is we're going to take a look at the management's comments for this quarter and then talk about my expectations for what we will see from Cumulus throughout this year and beyond. So now first we're going to take a look at the key financial highlights. So obviously looking at year over year performance for revenues and earnings isn't going to be beneficial. Obviously the 2019 numbers are going to be stronger than 2020, but what I think is most important to look forward to with this company is their trajectory and where they're likely headed over the next couple of years. So obviously we saw a decline in revenues of 11%. Year over year, total revenue decline of around 10%, which actually isn't bad when you think about the severity of what happened last year. But on the bright side, again, extreme growth on the digital side, revenue growth over Q1 2020 with the podcast revenue growth of approximately 35%. So this is the part of the business that I'm super bullish on, just extreme growth on the podcast part of the business. And I expect this to continue. Now, in addition, they've continued to cut costs. If you remember back last year, they cut around 36 million of expenses that they would continue to realize, and there's a portion that they would continue to realize going on from here. So in this quarter, they had more than a $10 million year over year permanent cost reduction, and this increases their expectation to more than a $50 million permanent improvement in expense run rate. When you think about the market cap of this company, this is like under a $300 million company. A $50 million improvement in expenses is absolutely huge. And that is to the credit of the management team. They could have done what a lot of other management teams out there, not really keep track of expenses, give out big bonuses, have a nice plane, a nice corporate office. But this company really placed a priority on cutting expenses. They said that last year that was their top priority, and so far they are absolutely delivering. And then lastly, they strengthened the balance sheet again, finishing the quarter with $294 million in cash. This is an increase of $22 million with cash, and they now have net debt of around $689 million. And again, the trajectory of the net debt is that it pretty much just keeps decreasing quarter over quarter. Back at the end of 2019, they had over $1 billion in debt, and that is getting cut down drastically and will most likely continue to do so. And so for the operating summary, again, net revenue of $201.7 million, a slight decrease from first quarter 2020. Again, that's before everything really happened. A net loss of around $22 million, which was to be expected. But they did have positive EBITDA of $8.9 million and adjusted operating cash flow, which we will get to, and what I think is the more important metric to look at compared to something like earnings. So now we're going to take a look at the earnings call to see if management has any insights into the future of this business. First, the CEO talks about the macroeconomic environment, how it's continuing to improve. They've never been more confident in their strong competitive position, in revenue growth drivers, and ability to generate free cash flow and operating cash flow. Then she gives some data that shows that small businesses are thriving again. Around 90% of small businesses are already back to pre-pandemic levels. Obviously, this is important because as a radio company, a lot of the customers buying advertising from you are going to be smaller local businesses. That's really one of the main ways that those type of businesses advertise. She also touches on another trend that I think has the potential to be absolutely huge for this company, and that is the explosion of sports betting as an advertising category. So again, obviously, there's all the obvious sports betting stocks out there. You have DraftKings, you have penn National Gaming, but I think an under the radar way to play the legalization of sports betting is through companies that will be advertising these services. And I think Cumulus is one of the most under the radar out there. Again, a reason that this is because Cumulus has the rights to the NFL over their radio networks. So if you're one of these sports betting companies that wants to advertise, obviously this is the radio company you're going to want to go to. And to evidence the huge growth in this category, the CEO says that they've already nearly doubled the business committed for full year 2021 as they had in the entire year of 2020. So if you let that sink in one quarter of this year, they already have as much business from sports betting as they had in the full year of 2020. Obviously, this is huge, and I'm expecting in a couple of years, 2 or 3 years down the line, I think sports betting could be one of the top advertising categories for Cumulus. And now, as a final comment from the management, another important development is that they're selling off a nice piece of land in Nashville, Tennessee, which they do think will bring them a sizable chunk of cash to continue to pay down debt. So they talked about this in previous quarters, and as of now, they say they're in the midst of a competitive sales process for this piece of property that they have in Nashville. Obviously, this is very good news. The real estate market is booming right now, so they're going to get a nice sum from the sale of this property. They've said in the past that they're expecting to get between 20 and 25 million, and that would be great for the company to just give them some more cash to have on the balance sheet and probably eventually to be used towards paying down the debt that they still have. Now, lastly, we're going to take a look at how the revenues of this company are trending, because even though the headlines are saying revenues down 10%, down 20%, if you look at the trend that the revenues are following, it's actually a very positive sign. So if you take a look at what's been going on in the previous call it 5 years, revenues have been pretty stable for this company. Obviously, this is a slow growth company in an industry that really isn't growing at all, which is radio. So revenues were pretty flat. And then obviously last year happened. So in Q2 of last year, obviously the revenues took a massive hit. And that is right here where they only brought in around 146 million in revenue. But what we've seen since then is that revenues have been increasing each quarter. So we had a huge jump in Q3. Q4 is a huge spike because we had, in addition to normal revenues, we had political revenues, which was obviously a huge driver for revenue growth in the Q4. And then we saw a slight decrease from that, obviously because there was no presidential election this quarter, in the Q1. But if you take out this boost from the election revenues that were brought in, it's a very clear uptrend where it seems like every quarter since Q2 of 2020, revenues are increasing. So I expect it to be, and I expect this trend to continue. I think this year, every quarter will have increasing revenue numbers, and eventually we're going to get back to this, around 250 to 300 million range in terms of revenues. I think that could happen as early as the end of this year. And so again, that's the trend to watch out for. Revenues tracking up. Again, with the expense reductions, this is going to result in positive earnings at some point. They've been positive on cash flow, but eventually this is going to trickle down to net income. And again, I think that could be another turning point for this company where they start to be valued like an actual business that is capable of making a profit compared to a business that's priced like it's about to default on its loan. So now lastly, we're going to take a quick look at the stock price. Hasn't really been doing much over the past couple of months, really since December, just going in a sideways range. And this is something I'm not bothered by at all. I am more than welcome seeing a consolidation like this right around the $9 to $10 range. And obviously this performance is very welcome compared to what's been happening in the stock market recently, where all these tech stocks have been selling off, some as much as 50-60%. So to see Cumulus just holding steady is a good sign. And again, my expectations are, this company, or the stock price is just setting up for the next leg up, which again, I think could happen relatively soon. In terms of my position, I'm not selling any. I've said previously, I think this company is worth at least $18 to $20 a share. So that's another double. So that's around another double from here. And even there, I'm not sure I would sell either, just because of the prospects of this business and what I think they have the potential to be 3, 4, 5 years down the line. So that's it for this video. Just wanted to make a quick update on Cumulus Media. Let me know if you're still holding the stock, because I know a lot of you bought in when I was first making my videos on this company last year. So I'm going to start putting out videos a lot more consistently again. So if you're not subscribed already, hit the subscribe button and also hit the bell icon so you get notified whenever I upload a new video. So that's it for now, and I'll see you next time.